Hi everyone. So today we're going to build the weighted average cost of capital and the cost of equity for Booking Holdings. The way we're going to do this is we're going to take each of the components, calculate them if we need to, and then just plug them into the number so that we get a WACC. So as we went over in the last video with Chipotle, the WACC is the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And we can calculate all of these figures using these all these individual components. We're going to have a separate sheet for the cost of equity because that's a bit more complex, and we'll go through it when we come to it. But the cost of equity, as we already know, is so the cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. And obviously the risk-free rate is the Booking Holdings reports in USD, even if it's not incorporated there, it reports in USD. So we'll use the US 10-year as the risk-free rate. We'll build the beta from scratch. We'll use a bottom-up beta instead of what it is relative to the NASDAQ index. And then we have the equity risk premium. Unfortunately, Booking does not break down its revenues by region or even country. So what we're going to do is we're going to use a global risk premium that's weighted by GDP, and then this should give us um, a better a better risk premium than what it would be if we just use the US one, because obviously Booking is a global company. It generates revenues from all over the world, so its risk is global rather than just to one individual country where it's where well, whether it reports in dollars or the fact that it's domiciled in the Netherlands. So we will build we'll do that, and we'll build the cost of equity in this format. So we'll find out what the risk-free rate is. That's simple enough. The bottom-up beta is a bit more difficult because we have to identify the industries that Booking operates, and then work out the proportion of those in the beta to then give a weighted beta, and then we lever it so that we can we can plug it into the cost of equity, which is then plugged into the WACC. And yeah, and it's the same with the global risk premium, except that we only really need one here. We're just going to use the global figure because we don't have the individual breakdown of figures. Okay, so let's start. Let's go on to a new sheet. As always, the first thing we do is we take off the grid lines and we go BKNG here, go data, and we can pull that up from Excel. There we go. And is that visible there? No, let me zoom in. That's better. And what we want here is the market cap, and that is going to equal, we want, actually, sorry, let me just fix that. It is going to equal, and because the financial statements report their figures in millions, we need to divide this by a million so that it is standardized. Then below market cap, we have the percentage of equity, which we can't calculate yet because we need the debt figure for that percentage of equity. Then we have cost of equity, and we'll put the components for the cost of equity here. We'll make this column be a bit bigger so that we have a bit of space. Then we have the beta, then we have the equity risk premium, slightly larger. I will zoom in a bit more for you. Then below that, the next one is debt, percentage of debt. Then below that is cost of debt. tax rate, and then we want a total, and then we can have our WACC. So so we know what the debt is because we can just go on the balance sheet. If we look over here, we can see that for debt, the company has on short-term debt $999 million, and on long-term debt it's $17.473 billion. So let's put that in. We go equals 999 plus 17,473, and let's just format it. Get into the good habits of making it look neat. And now we can get our total. So we do the market cap plus the debt. And to get the percentage of equity, we take the market cap divided by the total. Let's put the percentage. Okay, yeah, let's have it to 2 decimal places. Then we want the percentage of debt to be with the same thing again. The debt divided by the total gives us the percentage of debt, and we just reformat it. There we go. And to work out the cost of debt, what we have to do is on the latest 10Q, which covers the financial statements up until June the 30th, we need to take this interest expense. Let's multiply it by 2 to get a full year figure because these are half year reports. Well, this just covers up for the first 6 months of the year. So we'll do 1067 multiplied by 2, and then we divide that by the total amount of debt. So go equals 1067 multiplied by 2. Let's put that into brackets to keep it, make sure so it doesn't get confused. Divided by the debt. Let's go divided by C10. And that gives us, well, it's quite expensive, 11.55% cost of debt. Now for the tax rate, the way we have to find this is it should say in the statement, if we go down into the tax section, we will see, where is it? It's not, here we go, income taxes. So the company's effective tax rates for the 3 and 6 months ended June the 30th were 18.9% and 18.1% respectively. So let's use the 8 because that's the 6-month figure. Let's use the 18.1%. And yeah, that's good for now. Now, the next step is we build out the cost of equity. So let's rename this WACC and let's build another. Okay, let's go WACC. Call it the WACC, exclamation mark. Now, open a new sheet. I'll zoom in a bit. First thing as always, let's remove the grid lines. Let's go view. We need to freeze the first column and we can insert, make this a bit bigger. And again, if we remember, we're going to build out this cost of equity and break it into the three, well, it's obviously already broken into the 3 components, but what we want to do is show how those are constructed. So let's start with what will be that top row is going to be, we don't need to go far, I think to about K should do it. Let's fill it. Let's zoom in a bit more, make sure it's clear. So this is the cost of equity. And that is, so the risk-free rate, the beta, and the equity risk premium. And these are, I guess let's just go back to it. We can see, yeah, sorry, 1 second. Okay, sorry, I forgot a, let's go cost of equity. This is more an aesthetic thing, really, just to make it look neat and we can even get this ready on how it will be the risk-free rate plus the beta times the equity risk premium. And as we construct it, this will automatically populate. So let's do the risk-free rate first. That's always the easiest one. And the risk-free rate we're going to take from the US 10-year, and that is 4.232% at the moment. So we just put that in, 232, and that equals, well, we would normally say sum and go, obviously there's only one component, well, one line in there, so it doesn't really matter there, but in general, on other parts, that's what we would have to do. Where's it gone? There we go. Well, we want this to be like that. We want the border with this and go boom. Come on. There we go. And we put that the risk-free equal to this. We can even bold that one now. Then the next is the bottom up beta. And this one is a bit more difficult because we have to identify the industries that booking operates in and find a weighted average of each of them so that we can get a more accurate beta. So the first one that we're going to say that booking, and this is actually quite interesting on the revenue. Well, where's the thing? Okay, so if you can see here, booking approximately 89% of the company's revenues for the 3 and 6 months ended, respectively, relate to online accommodation reservation services. Revenues from all other sources of online travel reservation services and advertising and other revenues each individually represent less than 10% of the company's total revenues for each period. So 89% comes from uh, the online booking for accommodation. So we'll put the first industry as hotel and gaming. So we go, and yeah, I'll quickly revert back to the other one. Sorry. Yeah. So as you can see, I've broken it down into three different segments: hotel gaming, air transport, and advertising. Obviously, the hotel bookings is the largest segment, and the other two are fairly small in relation, but they still matter, and they have very different valuations for each of those segments. So let's get that populated. So here we want the unlev beta revenues. Then the next one is EV to, is it? Sorry. This one always, yeah, EV to sales. The value of that, then we go way proportion, weighted beta, and levered beta. Proportion, weighted beta, levered beta. Perfect. I can remember that. Proportion. Let's call it weight beta so that it fits. So yeah, let's put the first one in, hotel gaming. And all of this data comes from Professor Damodaran's website. He publishes it, I think, once a year on things like the beta, the country risk premiums. He does twice a year, but for most of this type of data, he's the go-to for it. Therefore, that's the one where we're using his data. Hotel, I don't want to bold. So unlevered beta for hotel and gaming is, where's that? That is there. So after effective tax rate. Oh, this one. This number, 0.9. The unlevered beta is 0.9. Let's do, um, because we'll need more decimal places, let's just do that. Number. Then the revenues for this segment are going to be, well, we know for the year, well, if we forecast for the year that this year, Booking will do 11,560,000,000 multiplied by 2. And then we times that by 0.89 because that's how much of the revenue, 89% of the revenue comes from the hotel booking side. So that gives us 20,576,000,000 of revenue comes from the hotel booking. Then the next segment that we said was, let's do advertising. And we know that advertising revenues, let's say, equals 577 multiplied by 2. And the beta for that is, it's just at the top, I think it's 1.12. Yeah, 1.12. And we'll do air transport being the last. We know the beta for this is, get it now, 0.69. So we take let's go back to the revenues again. We take the final figure, 11,560 multiplied by 2, and we subtract the hotel revenue, and we subtract the advertising revenue, and that should give us how many, say, plane tickets are booked through Booking, and that's at 1389. Now for EV to sales, we use this spreadsheet, so 2.75 for advertising. Is that visible? Is that better? Yeah, 2.75. So for advertising, I'll do it as they become visible. Air transport 1.02. Then hotel and gaming, which is obviously the largest, 4.28. Wow. Then to work out the value of each revenue segment as if it was its own company, we take the revenues multiplied by the multiple. And actually, let's just get the sum of these. And then the proportion is going to be the value divided by, so remember to lock in, we pull this down. Yeah, looks good. Then the weighted beta is going to be, we take the unlevered multiplied by 0.95, and we just pull these down, and we can then, now the levered beta, so the formula for this is unlevered beta equals levered beta divided by 1 plus 1 minus the tax rate times, what did we have it down as? 1 minus the tax rate times the debt divided by the equity. So we know the unlevered beta, we don't know the levered beta. So we're going to have to multiply this last bit, the denominator, 1 plus 1 minus the tax rate, multiplied by the debt divided by equity against the levered beta. And that will give us, so against the unlevered beta, and that will give us the levered beta. So let's do that. So we do equals multiplied by 1 plus 1 minus, and we know our tax rate because it's in our WACC. Let's get some more space here, and I'll leave multiplied by our debt divided by our market cap, and that should give us what we need. And there we are. So the levered beta is, well, it's 1. It's a bit disappointing. It moves. There's yeah. Let me just make sure I've got that right. Da, da, da. Did I put it right? Yes, it is right because I've used a different. I got the cost of debt wrong on the other one, but this one is fine. So this goes bold now, and this can be, all that hard work just for the beta to be 1. It can be a bit frustrating sometimes. Well, not frustrating, but it's a bit like, oh. What's the point? Okay, that's looking good. Now let's do the equity risk premium. So as I said, Booking doesn't give a breakdown of where it generates its revenue. Therefore, we're going to have to use the global risk premium because Booking is a global company and it operates in so many countries. But we'll use the global risk premium generated by Professor Damodaran, which is a risk premium weighted by GDP. So obviously the larger GDP countries such as the US, China, etc., will carry more weight. And let's be honest, that's probably where the more of Booking's revenue is coming from. So I think it's fairly accurate. But it would be nice if Booking could, well, give some sort of breakdown on where those are. So 1 second. Actually, let's put this down here. And we want 2025. So we're going to put the 2025 revenues here, which we're going to say is being equal to 11,560,000,000 multiplied by 2 to give us the full year. Then we have, sorry, 1 second, let me just, the weight ERP, weighted ERP, yeah. Weight ERP and weight ERP. And we'll just center those to make them look a bit neater. And we know this is 100%. And if we look on and these are all available to download. So this is Professor Damodaran's spreadsheet of where he does it for each country, calculates an equity risk premium. But obviously we don't know what the breakdown is for Booking. So we'll go to the bottom and you can see this weighted average ERP. That's what we'll use. So we'll use this 5.88% figure. And the weighted ERP then equals, and obviously we would have a few rows here, and the weights would be 30%, 40%, and then and we would do it in the same way that we did with the beta up here. We would do the same with ERP, but we've only got one line item here, so that doesn't need to obviously we don't need to do it there. But if we just go border, sorry, let's just make it again. Always presentation is just as important. And you go, yeah, just you always want to do your checks to make sure it all balances up and it aligns with what's on the financial statements. So yeah, we have our ERP here. Let's just give it that. We put this is equal to F27. And then now we have our cost of equity, which we just need to format into a percentage. There we go. So yeah, as you can see, we've built out our cost of equity and broken it down into each segment to give us an idea of what goes into it. So hopefully it's a lot more accurate than just using, say, what the what Yahoo Finance would say is what the beta would be. So let's go back to this sheet now, and let's keep all of these. As they keep the breakdown so that it helps us it helps us visually when we're planning the yeah, okay, so cost of equity now is the risk-free rate plus the beta multiplied by the equity risk premium, which obviously we know that from the other side. So now we can build the we can calculate the WACC, and let's remember what the WACC is. The WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So we know that. I'll just put this down here so that it's a bit more visible. So yeah, so that's the WACC. So let's do it. Equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And all we have to do is just format. No, that's not right. I've done something wrong. And that's exactly where it is. That should be multiplied by C5. There we go, 10.03%. And that's it. Yeah, that's it. We've got the WACC. And in the next video, what we'll do is we'll actually build the DCF model for booking. I just wanted to show the breakdown of how to do a WACC and cost of equity. And yeah, that's great. Thank you for watching, and I'll see you when we do the full DCF build for it. Thanks, guys. Bye.